This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com. This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome a returning guest back to the show, and that's my good friend Paul Moore. He is the founder of Wellings Capital and just an all-around great guy and an incredible source of knowledge and wisdom about the real estate market, the economy, and more specifically, the commercial real estate market. Now, if you're thinking, I'm a residential investor, Jason, that's what you specialize in. Well, hang on a second. Commercial real estate is putting a lot of pressure on the banking system right now, and we're going to talk about that. There's some important stuff you need to know there, so let's dive in. Be sure to stick around to the end. Paul, welcome back. How are you?
Hey, doing great. Such an honor to be back here, Jason.
It's good to have you always. Remind our listeners, where are you located?
We're in the booming metropolis of Lynchburg, Virginia.
Good stuff. Well, Paul, I don't know where to start. You know, there's always, whenever we talk, we could just go on for hours and hours. Last time I saw you in person, we spent, 2.5 hours at Starbucks talking. and that was a great conversation. But, you know, the commercial real estate market is pretty mixed right now. You run a fund that invests in some of the better parts of the commercial real estate market. You know, namely the office market and a little bit of the multifamily are under some real stress right now. And people are reading the headlines about that, hearing about it a lot. Yeah. Tell us what's going on.
Yeah. So one thing I love to tell people is that, you know, when you say commercial real estate, you're really talking about 12 or 13, 15 different asset types. And the headlines have been, and I'm not trying to defend or criticize the headlines, but I mean, I saw a headline that said, the biggest crash ever is about to happen in commercial real estate. And I read the article.
Sometimes what's interesting, they just say real estate.
I know.
Yeah.
And so I read that article and it cracked me up because every single thing in the article, bar none, was about the office market. It didn't even mention anything but office. Right. And it was drawing on sources that were only the office market. So it was a great headline. And there were several others like it. But, you know, when you talk about commercial real estate, you're talking about self-storage, mobile home parks, RV parks, strip centers, office, hospitality, hotels, cell towers. You know, you're talking billboards. About all kinds of multifamily, billboards. We're talking about all kinds of different stuff. Sure. And so while there may be a crash in one, there may not be in another. And while there may be a huge downturn in Tucson, there might be a surge in Marietta, Georgia. And so it's just so different. And let's face it, even if sometimes when you get a good deal, the financing on that deal takes it under, right? Mm-hmm. And so
vice versa.
We're seeing a lot of that right now.
A bad deal can be improved by great financing.
Yes, that's right. Yeah. I mean, just like a mediocre deal can be upgraded by a great operator, well, a great deal, a really well-performing, let's say multifamily, can be destroyed by floating rate debt that has just ballooned out of control, and the folks might lose it back to the bank, and that could happen.
And just to elaborate on what you said, you know, you talked about the segments, the categories of commercial real estate, of course, and then you talked about the geography, the location of them, but also the price segments, right?
Right.
You know, is it an institutional level investment? That's a different set of buyers and sellers versus a private investment that's a little bit less expensive in the commercial field. That's a different set of buyers and sellers. And so these are very different markets, but we have you here to help us unpack it. So start where you like. Yeah.
Yeah, I mean, let's just take self-storage as an example. So when I went to Nashville last time, it's been a while, but I looked around and there were self-storage facilities everywhere. So I'd say if I was just glancing or even looking at the map, I'd say, probably don't want to invest in self-storage here. But there was a whole section south of town, I believe it was called Bellevue or Belleville, that had no self-storage. And so, again, even within one asset type in one city, there can be a very different supply and demand metric. And so specifically, I think it would be great if we talk a little bit about multifamily. I mean, multifamily became the darling, the rock star, if you will, of commercial real estate. Commercial, by the way, commercial multifamily is anything over 5 units.
Yep.
Large scale commercial, of course, over 70 to 80 units when you can afford a property manager and a maintenance person typically. I wrote a book called The Perfect Investment. I know, humble title. That was in 2016. And by 2018, I was on lots of podcasts, including yours, saying, time out. It's not the perfect investment. It's actually nothing's perfect if you have to pay too much to get it. And if you have to finance with floating rate debt. And if you have to assume that the rents in Tucson will continue to go up 18% a year. And if you have to assume that you're going to be able to drive down costs, even though they're inflating everywhere else. And so there's a lot of mistakes that were being made and people were overpaying. I mean, I was bidding against them, Jason. They were overpaying by 20 or 30%. And now, as a lot of people were playing musical chairs, and people I bid against were able to sell those deals for 10, 20, 30%, 50%, 100% profit on the equity in some cases. But the music stopped, and some of those people are now without a chair. You know what I mean?
Right. Yeah. Tell us more about the commercial real estate market. We're talking multifamily. What else do you want people to know about the multifamily? And then let's maybe jump over to another segment.
Well, amazingly, I think that multifamily is largely still overpriced, especially relative to the current cap rate. Somebody could even argue that it might be more overpriced right now than it was at the height of the boom in what was that, early 22, let's say. I just read the other day that the average cap rate in Phoenix, or maybe it was Arizona in general, has risen 59%, meaning the value of the property, if I got my math straight, should be down by 59%. I doubt that that's happened.
Or the income went way up, which
Yeah.
I also doubt that. Yeah, but okay.
Right. Yeah. So if the cap rate went from, let's just, and I'm doing the math live here, so this could be a problem.
Sure.
But if we go from a 3% cap rate, and I'm making that up, to a 5% cap rate, that's 2/3, 2 divided by 3, that's a 67% drop in cap or expansion of cap rate. That's what I meant to say.
Mm-hmm.
So therefore, if the value formula of commercial real estate, value equals net operating income divided by cap rate, if the denominator is 67% higher, I'm doing the math live here, but I think it should mean that the value is 67% lower. So 59, in other words, sounds about right. It really does. Well, I don't think that's happened, Jason. I mean, I spent the day with a guy the other day who said that he had sold 2 very large multifamilies in Phoenix or Scottsdale the last couple of years. And those brokers are coming back to him now saying, hey, they're in trouble. They want to sell it back to you for just the value of the debt. In other words, they know the equity's already wiped.
Right.
And he said, no, it's not worth that. But
so it's not even worth the debt value.
Not even worth the 75%-ish of debt that he.
So the name we use for that is underwater. It's underwater.
Yes.
Yeah.
Right.
Okay. And do you have an estimation or, any stats to share with us about, like how many multifamily properties are underwater? The statistics for that kind of stuff are harder than they are with residential, but any insights?
No, I don't. I just heard that the peak of the short-term or the floating rate loans coming due is around December. So we're only about 2 months away. We'll see if that's true.
Okay, so that'll be sort of the hump of the camel, right? Yep. And that's the peak, but there will still be a lot of them after December. And it takes a while to kind of wash out, even if the peak of the loans due in December, like that means there's a default that occurs in December or January. And then there's the workout process and everybody's negotiating and the lender's threatening and the borrower's threatening and they're, maybe they can meet and work things out. Or has rescue capital entered the market much yet?
Yeah, rescue capital is entering the market, and that's something we should probably talk about.
Yeah.
We
And maybe
are,
define rescue capital first. Yeah.
yeah, so we're investing in preferred equity right now, and I want to be really clear, we're not doing rescue capital. Some people think those are interchangeable terms. Rescue capital could be, for example, this is a model of pref equity. So right now, the reason we're talking about rescue capital, but I'm going to back up a little bit, go to a higher level, and just say what's pref equity. And this might help answer the question. So with pref equity right now, you've got, deals that are coming in that used to be financed at 75% LTV. Now they're only at 50 or 60. So that's the debt down here at the bottom. Equity, people aren't raising equity as fast and as voluminously than they used to. And so they're coming in at only 25%. So that's leaving a gap. So gap financing could be either mezzanine debt, or it could be preferred equity, in this middle tranche, okay?
For those listening only, Paul is showing a diagram here of 3 different types of equity. Top 25% common equity, middle 15%, which is preferred equity, and the bottom 60%, which is the senior debt.
Yeah, right. So pref equity would be in the middle. And to answer your question, what's rescue capital? Well, sometimes these syndicators will say, hey, I don't think my 25% common equity people, I'm not sure that's the best example right now because this is about a purchase, but at any rate, I'm not sure my common equity people want to have a capital call. So what are we going to do? Well, we're going to bring in some rescue capital in the form of pref equity that gets in front of the common equity and it gets behind the debt. And that rescue capital is going to have, let's say, a very high price tag, like let's say 9% current cash flow, and then plus 5 or 6% upside when the deal's refinanced or sold. So it's definitely, well, I shouldn't say definitely because I'm not supposed to speak in absolutes. So says my compliance team, but it's almost certainly going to dilute the common equity pretty seriously. And if the value of the property goes down, the common equity people are going to take the first hit and a bigger hit because that pref equity got slid in the middle in front of them. Does that make sense?
Yeah. Okay, so if it's rescue capital, these are the people that are sort of preying on the misfortune, you could say, of these investors who bought this property, but they're also helping them. So, it depends how you want to look at it, of course, right? But what are the rates on it, or what are the terms of those deals that make it rescue capital?
Yeah, I mean, they might be pretty high, like maybe 10% current cash flow, and then another 7 or 8 or 9% compounded return at the time of sale or refinance. So maybe a 15 to 18% total coupon as an example.
And so does the general partner or the general partners, do they just say to all the limited partners, look, you're taking a haircut on your investment here? If they've got 50 people that put in $100,000 each on this deal, right, and they're a syndicator, do they say, hey, your investment is now only worth 50,000 instead of 100,000, and we're going to try and turn this ship around slowly, or what?
I don't know if they would say that to them, Jason. They might say, well, if this hits our original projections, you guys will still make almost as much money as you would have before. So, but
but the original projections got them in the mess in the first place.
Well, yeah. And like one syndicator said, no one could have ever predicted interest rates would go up. And I'm like, no, that's not true.
You could predict they would go up, but I don't know if you'd think they'd go up that aggressively.
Fair enough.
To give them a little bit of a break there, but yeah.
Okay. Right. So anyway, this is pref equity. We're investing in pref equity, like I mentioned, but the rescue capital looks much the same. Now, another form of rescue capital is just what everybody would know, and that would be just having a capital call where you call your current LP investors and say, hey, we need you to give us some more money if you want to save this deal.
Mm-hmm. Yeah. Okay, cool. So that's the multifamily market. Want to tell us about the office market? Also tie it in with multifamily. I'm especially concerned about how this is going to affect the banks. We've had a few bank failures, not nearly as bad as the doomers said that it would be, but there may be more. What should we be worried about there?
Yeah, so we know of a multifamily syndicator in, doesn't matter where they are, but their bank came to them and said, hey, your deal's just fine, but we're not going to refinance it. And they're like, what? We're doing fine. Everything's going great. They said, yeah, we're taking such a hit on the office side that our board is telling us to not refinance other commercial real estate deals so we can, pull in, capital to just stay liquid. And so
basically,
that's one thing that's really bad.
That's really a contagion issue then.
Exactly.
Right? In other words, the bank said, look, your deal's good enough. We would do it normally, but we can't because we're having so much pain in our office market portfolio.
Yeah, that's right.
Interesting.
That's exactly right. And I think the problem with office, people, Buffett and Howard Marks and all these brilliant guys, Sam Zell, they'll buy stuff when it's on sale. I follow those guys and I love their thinking. But office might be a little different right now. I mean, think about it. We have a first in world history for sure. And that first is that a significant percentage of people can work remotely. We've also got this pandemic that caused people to say, hey, I'm not going to keep working 80 hours a week in Manhattan. I think I'd rather spend more time with my family. I'm going to slow down. I'm going to buy an RV. I'm going to hit the road. Yeah. By the way, we should talk about RV parks, but
we can. But what's interesting about the RV idea is that they can also work mobile better than ever. Because, I got to tell you, having traveled extensively and having been to 92 countries now, I got to say, I'm pretty impressed nowadays with internet access.
Yeah.
Just even 4 or 5 years ago when I would travel around pre-COVID, it was terrible. I mean, I'd go to coffee shops and restaurants trying to find a connection, and it was like really bad. I even had a business idea as to how to solve that. But now, it's pretty acceptable in most places.
Right.
Yeah.
Yeah, absolutely. In fact, RVs are now being outfitted with, because it's Skylink from Elon Musk.
Starlink, yeah.
Yeah, Starlink. That's right. So that will allow them to have much more access. But a lot of the RV parks, the ones we're investing in especially, have very good internet. That's part of the gig. But anyway, back to the office. I honestly wonder if office, I know people say this all the time about all kinds of things that are in the toilet, like 2009, they were saying this, but I think there's a good argument that office might never come back to where it was.
Yeah. Unless the overall population increases dramatically, then the office segment of the population would also correspond to that, but it would have to be an adult working professional type population. That's one way I could see it happening, or just an alternate use, which these alternate uses really aren't working very well. They're very expensive. And what's interesting is that the older office buildings work much better for apartment conversion than the newer buildings. And one of the main reasons is that the older buildings aren't very efficient. And they have windows that open instead of being encased in glass. And they have much smaller floor plates. So lend themselves much better to design where, in a residential, you're not going to have a 25,000 foot floor plate and only windows on the perimeter, right? So they're much smaller floor plates and everybody can be close to a window. If you put 4 units on a floor, for example, that works. But in the newer buildings, those are the ones that are actually really suffering. The older ones do work for conversion pretty well.
Yeah, and I know a friend of mine, AJ Osborne, you might know him. He's converted an office in Boise, I think, to a self-storage facility. And it's rare that those work, though, without a lot of reinforcement of the floor. So, they have
because self-storage is heavier than an office.
Much higher, yeah.
Oh, right. Interesting. How many floors is that?
I don't know. I think I heard it was 5 or 6. It was owned by a newspaper. So that's one of the reasons it was so well reinforced.
It had strong floors for printing presses, probably.
Exactly. And he bought it. I actually don't know how many floors it was, but he bought it from the bank at less than the value of the land. So pretty good deal.
So he got the structure for free and the land value for a discount. That's a pretty great deal.
Yeah. So AJ is pretty good at, he's done a lot of these type of conversions that have just been really have just been wonderful.
So, Paul, what does this mean to the banks, though, if the office market just never comes back, which I agree with you, that's a real concern. The banks and the insurance companies, because life insurance companies love offices for investment too, pension funds, endowments, they're going to all take a hit. How bad is that going to be?
Yeah, I wonder if it's already about as bad as it'll be. I can't imagine. I don't know. but I don't sense that it's going to get much, much worse. It actually seemed worse a year and a half ago. It almost seems like people are coming back to the office right now. I just talked to a Manhattan hedge fund co-founder a few hours ago, and he said, we're finding that these teams in our 4 different offices, they need to be together. And so we're not working from home anymore. And I think there's a lot of that. So I kind of wonder if it's
that's
just
what the employers want, but it's not what the employees want mostly.
Oh, no kidding. Yeah. I mean, we work out of home. Most of us work out of our home at my company, but we like to be in the office a few days a week. You know what I mean?
Okay, so we just don't know how that'll turn out. But, even if the vacancy rate has already sort of stabilized in the office market, and say the new normal is that you should expect a 30% vacancy in your building.
Right.
Maybe, right? That's the new normal instead of an 8% vacancy as in the old days, right? Then the question is, has the financial ramification of that worked its way through the system? And I would argue that it hasn't. Yeah, because that takes a while, renegotiating with lenders and loan workouts and loan mods and some foreclosures and, Yeah,
I agree. I've heard the lenders have been much more patient. I think I don't know if you've heard that, than 2008 and 9. Yeah. And as a result, that's prolonging the agony, it would seem. And I think you're absolutely right.
Yeah, it's taking longer to have real price discovery here. But I mean, some of these discounts on these trophy buildings that we've all read about, I mean, they're insane. These office buildings that were, $300 million are now 50 million. Like,
exactly.
It's unbelievable. It's like 1/6 of the price.
Yeah. Isn't that crazy?
Yeah, it's absolutely crazy. So it's going to be pretty weird. What other asset classes do you want to talk about? Maybe some positive ones.
Yeah. I mean, let's talk about RV parks since we touched on that.
Now, the distinction is you're talking about RV parks, not mobile home parks. I own a mobile home park, as you know, but these are RV parks where people come in for 1 night or 2 nights. They're much more transient. They're more of a business than a real estate deal. Tell us about those and why you like them.
Yeah, we love mobile home parks as well. But the RV ownership has gone up by about 60 or 70% in 2 decades. But like I mentioned earlier, you've got a once in a lifetime or once in world history shift just since the beginning of COVID. And that is a massive number of people. I mean, in the last decade, a huge increase in number of people that could work from home. But then COVID just, put that on steroids, as we all know. And a lot of people are working from the road. I know a CEO of a startup. His startup's in your part of the world. And he is full-time living in a very nicely modified RV now and traveling the country. So you've not only got the stay-at-home or the work remote revolution, you've also got the sharing economy has hit the RV world. So you've got RVshare.com, outdoorsy.com. People like me who don't want to own an RV will rent an RV. And somebody's like Whitney Elkins Hutton, if you've had her on the show, she said, that she bought an RV a year and a half ago. She rented it out for the first 6 months and she recouped half of what she paid for the RV in net profit in just the first 6 months. Yeah. And so these RVs that are now, that were sitting idle 49 and a half weeks average per year are now on the road or maybe going to RV parks, maybe, for example, 10, 20, 30 weeks a year. Well, that's putting incredible pressure on the RV parks.
Right. Okay. So there's a few things there that we have to think of, the dependencies and the things that could go wrong, right? So the RV sharing economy is pretty much like the Airbnb economy, right?
Right.
And we have to compare that to Turo, which is the car sharing,
right,
and Airbnb. I think they're in VRBO. Okay. So, obviously Airbnb has taken a bust. It's down pretty significantly because it's discretionary money. And when things get tight, people stop the discretionary spending.
Right.
But the other part of the RV issue is the fuel cost. And I remember I used to own a 38-foot motorhome, and I really enjoyed that quite a bit. I never lived in it, but I had it in a storage lot, paid about $200 a month. I had 2 different girlfriends through my ownership of that, and I used it. But as soon as I didn't have a girlfriend, I never used the thing. I just, never, it just sat there. And so I finally sold it, and gas prices had gone up quite a bit at that time. So I was really happy to sell it because I thought it would be very much hit by the gas prices. The hard thing to analyze, though, is maybe people just use them much closer to home instead of taking long trips.
Well, there's more truth in that. Most of the trips average, I've heard, an hour and a half or 2 from home. So
that's it.
That's close. What I've heard. I mean, I don't know that that's an average or just the median, but at any rate, what I was surprised, Jason, my Toyota Sequoia gets 12 and a half in the city. And when I came to visit you in it, you might recall, I was getting 17 miles per gallon. But Class A motorhomes get let me get this number right, 7 to 13 miles per gallon. Class B, 18 to 25 miles per gallon. Mm-hmm. And Class C, 14 to 18 miles per gallon. So honestly, I mean, these stats are similar to my Toyota Sequoia. And so it's not quite as bad as I thought,
Interesting. And some of those mileage stats, though, are probably on diesel. Like that Class A stat is probably a diesel.
Yeah,
so,
right.
And the mileage is always better on diesel. But the thing that I think will really revolutionize the RV business is when they become self-driving. That's a complete game changer, because you could literally go to sleep and wake up in a different place. That'd be pretty fun.
Wouldn't that be fun?
Yeah. But I think parks would still be needed and used, even if they are self-driving, because people still have to sort of stop somewhere.
Yeah, I mean, the kind of parks we're investing in have water parks, water slides.
They're destinations.
Yeah, they have drive-in movie, putt-putt golf, fishing lake, swimming lake, Wibbits, everything,
Yeah, so. Cool. So how are you finding those deals and evaluating them, structuring them? Anything you want to share there?
Yeah, so it's really hard to get debt on RV parks right now, sort of like self-storage might have been in the 90s. I wasn't around, I wasn't doing self-storage in the 90s, but I've heard that RV parks are where storage was in the early to mid 90s. So a lot of those deals are getting done for cash. And then once they're completely stabilized, they might be getting a loan from maybe a local or regional bank on these to, try to increase the returns. But a lot of these deals are getting done and upgraded for cash from what I'm seeing.
Interesting. And so do you like, certain types of parks or size range, deal size, whatever?
Yeah. So there's 4 types of parks that we have identified. Number 1 is an overnight park, and those are convenient, but they have little to no amenities. They're just on the way somewhere along an interstate.
Right.
A second type would be extended stay. That's the extreme opposite. This would be like around a lake. And they might have, these RVs are there to stay. They've got a deck built around them. If they have room, they might have a shed, a special, like a little entry door, et cetera, that's, built on. The third type is pretty obscure. That's workforce housing. These are people who are working on either a pipeline or an oil field or whatever, like up in North Dakota or Texas. Mm-hmm. These workforce RV parks are pretty popular. And then the fourth type is a destination RV park. And this is where all the value adds are. I mentioned Wibbits, and I thought I'd get a reaction there. But in case your audience doesn't know what a Wibbit is, this is a Wibbit. This is a park that I stayed at as part of our due diligence, and these are $200,000 to $300,000 floating obstacle courses that they rent to kids or adults for $17 an hour. Wow. And so that comes out to like $1,000 an hour in the high season. So it's a pretty cool value add.
The Wibbit, huh? Yeah.
Yeah, the Wibbits.
Interesting.
Yeah, okay. So there's a lot of value add.
Yeah, very interesting. All right. Any other deals you want to talk about or market segments?
Yeah, I mean, I really like mobile home parks since we brought that up. There's a tremendous shortage of affordable housing in America. And it's funny, these politicians, they're out there crying against capitalism and, for affordable housing. But those same politicians will not approve a mobile home park in, their neighborhood. That's called NIMBYism, not in my backyardism. Sure. And so mobile home parks are still the only asset type I know of that have a decreasing supply or a stable supply and an increasing demand every year. Mm-hmm. And there's still a whole bunch of mom and pops out there who are charging $100 or $200 per month in lot rent, they've been doing for 40 years, where the competitive rate is $500-$600 a month. And so it's, still got a lot of upside in those. I'm not saying somebody should go buy it and increase the price from $200 to $600 a month, but I am saying that there is some upside and that there is a real demand. And a lot of the mom and pops can't fill these empty slots because it might cost them $50,000 per lot to put a mobile home on it and then take the risk of selling that mobile home to a tenant. But a big operator can do that. They've got the financing in place, and they've got the the list of tenants that they've formalized by doing this thing called marketing.
Right.
And there's a lot of tremendous upside in mobile home parks.
Yeah, I agree with you. And as I've long said, America, whether it be a mobile home park or not, to solve the housing affordability problem, we have got to get rid of the stigma against manufactured housing.
Exactly.
Okay? So and
true.
That doesn't mean it's a mobile home or in a mobile home park. Just manufactured. It's much more efficient to manufacture big pieces of a house in a factory and bring it to the lot than to build it on site.
Absolutely.
I don't think anyone thinks it's a good idea to manufacture cars on site. When I buy a new car, they're not coming to my driveway to assemble the thing. Okay.
Yeah.
It's it's crazy.
Yeah. Well, Elon might make that happen someday. You never know.
Well, who knows? But there might be some better way to do it in the future. Nobody knows. Okay, Paul, well, give out your website, tell people where they can find you, and just any closing remarks you have.
Yeah, well, I would really want to encourage people to consider watching the movie Sound of Freedom, watching the older movie Nefarious from 2011 or 12 from Exodus Cry that exposes human trafficking. And so I'd really encourage people to consider joining me on Giving Tuesday to give to AIM. That's AIM. That's aimfree.org. We're raising a lot of awareness and money for that group that has 100% Charity Navigator score. So very impressive group. If people want to get hold of me and hear more about any of these asset classes or anything else, they can reach me at Wellings. That's WELLINGS, wellingscapital.com/resources. And you can get all kinds of free special reports and other fun stuff.
Good stuff. Yeah, that's a great cause, Paul, and I'm glad to see you're so involved with that, so passionate about it. And thank you very much for joining us today. Appreciate it.
Hey, thank you so much. It's a great honor to be here, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.